Now, before the break, we talked about the reserve requirements at China being adjusted. It went from 11.25% to 11%. But industrial profits were expected to be, last month were negative 2.3, came in at negative 3%. So you're seeing they're trying to do something, reserve requirements, but it's just not enough. And we don't see it being enough because there is no demand right now for debt. So then when you look at industrial profits getting worse, and if profits are falling, why am I going to go out and borrow more? Yes, rates have come down, but what am I going to borrow for? So now the banks only have to keep 11% on hold, so freeing up 25 basis points. But to who? Who's taking it? And that's where we continue to see the problem. Composite PMI in October was 49, came in at 47.1 in November. Manufacturing PMI was expected to be at 49, came in at 48. Non-manufacturing expected to be at 48, came in at 46.7. So the official data has gotten much worse. Now, when we look at Caxton, it was expected to be, manufacturing was expected to be at 48.9, came in at 49.4. But then services was expected to be at 48, came in at 46.7, composite being at 47. So when you look at it, manufacturing, depending on who you're asking, where you're asking, you can get some variation, but services and non-manufacturing are worsening significantly, and that's drawing down the composite. And that's weighing on employment. And employment is a huge problem when you look at the longevity of savings versus spending and where the consumer is going to go. Because there's a view that as lockdowns end, and we're going to talk about that in a minute, things will instantly get better. It's like, well, how were things when China was open and not locked down? Things were still pretty bad and not getting much worse. And this was when the globe was still a massive buyer because there was such a backlog. Now you have no backlog. You have a slowing global economy. If anything, in my opinion, a global economy in a recession, and you're going to see a lot of Chinese growth. It's more along the lines of China's going to just stop going down on an economic basis, but it doesn't mean you're going to get a shift higher. And I think that's the crux of what we're going to try to highlight here with some of the different data points. So now let's go into some of the new protocols. So on Monday, we should get more COVID announcements on Wednesday and Saturday. So if it comes out on Wednesday, we'll talk about it on the FSC show, and then again next week. But China may announce 10 new COVID-19 easing measures as early as Wednesday, which we'll want to look at. Monday, for the first time, national level state media began pushing a new narrative that the Omicron variant is nothing to be afraid of. They claim that the most difficult period has passed, and now the Omicron is weakening, and our response capabilities is increasing, which has laid the foundation and provide conditions for continuous optimization and improvement of control measures. The CCTV story recounted the experience of six former COVID patients to reassure the public. But again, Beijing city authorities ended the requirement to show a negative PCR test results to enter malls, supermarkets, and office buildings. But central authorities are belated rushing to prepare China to live with COVID. Between Sunday and Monday, 3 more China-made COVID vaccines were approved for emergency use. All 3 remain in phase 3 clinical trials, both in China and abroad. Approving under-trial vaccines for last minute seems an ill-prepared strategy for exiting a 3-year nationwide policy. But again, here we are. Beijing's zero COVID exit is gearing up for failure, which, again, as we've seen, pretty much any country, any reopening has been poor. And given how much fear they've created, and I mean, they were locking people in, they were sealing it up with, they were locking people in with welders, and it resulted in then there was a fire and people died because they couldn't get out. That's what created this massive pushback, and you're starting to see some of this rollout. But the sudden change, because they pivoted, has confused citizens, because it's like, all right, well, you were welding me in, now I can go out. And local governments were, you told me to weld them in, and now you're telling me not to. Now there's a broad concern of where do we go from here. Wednesday, Guangdong government made a U-turn within hours. City Hall emphasized strict implementation of zero COVID measures in the morning until the Guangdong provincial government ordered them to relax the policy around noon. So again, within hours, you're seeing this move. Thus far, the central government has not given clear direction on how local governments should relax restrictions. Most localities are opting to ease up on controls, though with considerable variation and at different speeds, and some cities are sticking to the old strict playbook. No matter what, after 3 years of massive effective state intervention, the Chinese public are unprepared for the imminent spike in cases. And that's another one where the government's telling you to do something and you're doing it, and now you're fighting because it's being done. But as anybody who experienced Omicron, as we did, if you look at someone with Omicron, you get it. It is highly contagious. And that is going, so then does the public panic when they see a move up in cases? Does the government panic and say, oh, zero COVID was the right way because this is absurd? That's going to be something that will be seen in the coming weeks, and I think that'll create more problem, more uncertainty in terms of how this should be handled, and that's going to become a much bigger problem. And then there's still a dire shortage of ICU beds in hospitals, and a steady hand from government is more important than ever to guide the country based on their different levels, but the government is not stepping in. And so they're looking, so now Trivium, a good quote from Trivium, we are looking at a very uncertain near-term economic outlook. COVID cases look likely to soar, which will lead to economic disruptions. It could prompt policymakers to reverse course, which we think is very possible and likely. All the while, manufacturing, still contracting just at a slower rate, but output is dipping again. And this is a key leading indicator. So yes, you had a bounce in Caxton manufacturing PMI, but output is moving down. Again, more of a problem on exports, imports. Where is that economic prowess going and the pressures that we see? So then when you look at PMI employment, look at where 50 is. 50 is much higher. And even during reopenings, even before 2016, 17, 18, manufacturing PMI and employment was in contraction. Now we have more pressure with the Wall Street Journal reporting that Apple is accelerating its plans to move production out of China. And so Apple is telling suppliers to plan more actively for assembling Apple products elsewhere in Asia, particularly India and Vietnam. And for those that have been following me, I've been talking about Vietnam for a while, but this is now another confirmation of where this is going, which is going to put more pressure on employment because Apple is a very big component of that. And as we've seen with the issues at their facility, with people climbing fences, being arrested, shoved back into the manufacturing, there is a lot of problems within that entity. And here you're now seeing them move out. In the past few months, Foxconn's factory, which manufactured about 85% of the iPhone Pro series at its peak, has been nothing short of chaos, largely caused by the zero COVID policy, as we've seen, with production facing massive delays. So here now, when you take all of that into context and look at the cost of COVID restrictions have fallen hard on workers, especially young ones. Unemployment among people aged 16 to 24 hit a record of about 20% in July. The rate has declined slightly in recent months, but is still well above that of other major economies. The high jobless rate for young people threatens long-term careers and lifetime earnings. Plus, it puts more pressure on local economies and creates this, well, where am I going to get a job? How am I going to do this? Where am I going to go from here? Lockdowns have dragged down local tax revenue and driven up government expenses. All 31 of China's provinces ran deficits on their general budgets in the first half, with some 23 provinces recording deficits that were bigger than their full year shortfalls in 2021 when measured as percent of GDP. So again, things are getting worse again, as we've been highlighting time and time again, that all of this onerous is falling on the government. They don't have tax revenue from real estate sales, from real estate. And they're being asked to provide more to employees that don't have jobs. But if you don't have jobs, you're not collecting taxes. And a lot of these companies are now leaving. So again, that's another tax revenue stream that is going away. And there is this spiral moving lower, which is picking up steam. But it's picking up steam on a structural change. It's not just cyclical. It's not, oh, well, less people want iPhones, which is true. Less people want iPhones because they're expensive. But structurally speaking, they're not going to be made in China. And that is, again, a structural move which has to be replaced. The longer strict containment measures stay in place, the worse the situation will become. But even when it gets removed, you'll get a little bit of a pop. But there's structural piece that is sitting behind the zero COVID policy is still real and still there and can't be ignored. So taking this further, income gains have suffered. Increases in real household income slowed to 3.2% year on year over the first 3 quarters of 2022, less than half the average pace of 6.7% in the 5 years before the pandemic. Meanwhile, savings rates are climbing again this year, a sign of economic anxiety that depresses consumer spending and growth. So when you look at PPI coming down, industrial profits also falling, industrial production fairly flat. But then when you look at international growth, international trade, international demand, we expect industrial production to roll down further, which again is going to put pressure on jobs internally, which is going to cause people to get cut wages, which will put more pressure on, okay, well, if you're cutting wages or if you have to be more competitive because unemployment is so high, well, you're going to accept the lower wage. So now you put savings in the bank. So are your savings going to go to make up the difference between what you were making and what you're making now? And that's why we just don't see this huge surge of spending. You might get a pop because people have been locked in. But in our view, it's going to be a pop and a fairly sizable fade given where they are on an economic footprint. Housing demand fell in the Eurozone this year, driven by higher interest rates. And the reason why we talk about housing demand in the Eurozone is because China isn't the only one. China, and we'll talk about China in a minute, but then you look at the Eurozone, and again, that is falling, and those pressures are there. So you keep seeing this cycle moving lower on a global level, because we'll talk about the US, we'll talk about Europe, we'll talk about China, and we'll pick on China a lot, especially given where their debt is at the local level. But it's not just them. There's a falling demand elsewhere. Asia, ex-China, and Japan quarterly reserves of US dollars is falling, even though they're out there actively trying to raise dollars. So as we showed previously in segment 1, they're taking treasuries, selling them, pulling in dollars, but now you're seeing dollars flow back out because they're trying to prop up their government, they're trying to prop up their currencies, they're trying to protect against inflation. But it also shows that there's less trade. And a lot of these Asian countries trade with China. So China is clearly still seeing a lot of pain. And based on the downstream impacts, there's really no buyers because global trade is slowing. So that's only going to get worse as it flows through the underlying economy. Liquidity-driven property downturn. So again, coming now back to Chinese real estate, China's real estate source of funds, bank loans have fallen, deposits and advance payments down, self-raised down, floor space started, obviously moving deeply negative. And that's where you look at these underlying slowdowns. And even though they've been told time and time again, the PBOC, the CCP has said, you need to lend to Chinese real estate. And they're like, okay, well, they'll go to these companies and say, well, we want to lend with you. And they're like, but we don't want your money because we can't handle it, because we're going to go bankrupt. Whether, right now they're trying to build running room and create some an impact to reduce leverage, try to get to the other side. So putting new leverage on the books is not going to do anything, especially when you look at a huge surge of floor space available and just nobody willing to buy it, given the fact that they don't have the income to support it, nor do they have the down payment, given a lot of these individuals lost their shirts in the investments. And that's what's also missed with the savings data. everyone keeps saying, oh, well, savings data is up. Savings in China is up. Okay, well, how bad is the real estate portfolio losses? Is savings above losses? Is savings below losses? Where is the consumer? Because that is going to adjust their propensity to spend on how much savings do they have and how much liabilities do they have, which is a big problem. China's COVID-19 restrictions cover nearly 60% of GDP, and that is going to get a bit better. But even as you look at the reserve ratio for major banks, it is again flatlining at this point. China manufacturing PMI, again, moving down. New orders, though, is the bigger concern and leads back to what we talked about in segment one. And then in the other segments about US and Europe, new orders are getting smoked because nobody's buying. So global trade is going down. And this is just another example, which is reverberating to emerging markets and keeping all that pressure there. And we don't see that adjusting. So then when you look at non-manufacturing PMI, the big reversal, employment, that is a scary move. And this was still negative in the end of 2018, in 2017, 2018, 2019. And even during reopenings, employment has only gone down, which again is just talking to more issues on available jobs for the populace. Services PMI, again, that moved down. Employment, steep drop in terms of service PMI. Again, all of this is just showing the pressure points that we've been highlighting. Chinese exports are set to contract soon, which we've already shown as a likely backdrop where the demand side now. So before they contracted because the world was closed, China was closed. Now the world is open. Huge supply chain surge, you needed to bring in inventories. That's now been met. And here we are. So that's why we've been talking so aggressively on there's going to be that big drop in Chinese exports, which is going to put more pressure on the economy. Even as you reopen, you're not going to get any of these benefits, as you can see here with the government stringency index moving down, still elevated versus elsewhere, but moving in the right direction. Contracting industrial profits underscore deflationary headwinds, which is a net positive when you think about, well, prices have come down, so that should support exports. But if people buy more from China, you're going to buy less from Germany. And that's when Germany and Europe is talking about their competitiveness is getting hurt, given some of these conundrums. New apartments needed each year in urban China are continuing to diminish, which again is also pushing that downward move where their population demographics suck. And as they get worse, that's going to make it harder to continue to try to prop up the economy with real estate and with infrastructure, which again, it isn't supported. Early signs of real estate debt recovering. Again, it's not so much a recovery, it's going to stop going down. And that's when you look at the sideways move, which is what we've been talking about, this more chevron pattern, which is becoming more and more pronounced. China's empty homes, cumulative surplus of housing supply over demand, 30 million units. That's a shocking number when you think about the amount of ghost cities that have been built and the amount of units that have been built and why it's just not going anywhere anytime soon. Developers have suspended construction on an unprecedented scale because there's 30 million units sitting unsold. You can't get lending. If you can get lending, it's at a rate that would send you bankrupt. And again, all of these just point to the problems are only getting worse in China, not better. South Korea exports, again, missing those estimates. Taiwan exports all slowing below 2021. They're showing you that degradation that we talked about in segment one when we talked about ASEAN nations. As China imports less, as other nations import less, these are key raw materials, semi-finished good materials that get imported, and you can see the pressure only accelerating. Bank credit growth accelerating. So when you look at bank credit growth, investment share in GDP, when you look at the underlying pieces of where this credit is, how it's growing as a percentage of GDP, it's been insane because of that shift in the investment share in GDP. Credit where credit's due, bank deposits and credit in the Indian banking system have come up. So when you look at India, you're starting to see a little bit more of the bank credit growth, which is what you wanted to see. When you look at bank deposits and credits in the Indian bank system have started to move higher, which is good, trying to create more of an internal cycle, which has been the net growth. And as you get more industry coming in, especially as you get that nearshoring or shift away from China, India is going to be a beneficiary of it, which will help push this higher further. While on the other side of the region, Japan CPI was expected to be at 3.6%, came in at 3.7%. CPI ex fresh food and energy, the survey was supposed to be at 2.4, came at 2.5. So again, Japanese inflation is surging higher. We don't see that stopping, which in turn is pushing real cash earnings much lower, expected to be at negative 2.2, came in at negative 2.6. And that's where we see that the buying power of the Japanese going down and other areas following suit. Japan manufacturing PMI came in a contraction of 49.4, but more importantly, new export orders at 45.6. So again, it's coming down on the top line, but then you look at the leading indicators, they've only gotten much worse, which again is going to pull down manufacturing further. You don't have local consumption to bridge you. You're going to continue to see this pressure, which is why we continue to remain underlying bearish, with composite output index, again, coming in negative, pulling down that GDP. We've already seen their GDP come in negative, and then economic conditions deteriorate in November. New orders, new export orders, all contracting. New orders to inventories steeply negative and getting worse, which again leads to what we've been highlighting, where it's China is now, we're seeing the reverberation out from OECD, China, and now into the emerging markets, which is where we see a lot of these pressure points. South Korea bank rates moving higher, trying to get in front of that inflation as consumer confidence worsens again, which again speaks to the problems we're seeing at the manufacturing side, as well as local consumption, which will keep a pressure on the South Korean consumer. And that's when South Korean's household credit year on year dropping like a rock, because why would you take credit when interest rates are going up? You're going to shun credit, try to live off of savings as much as possible, or live within your means. And most of these countries, typically Asia is more of a savings nation, and that's only going to get strengthened here. South Korean manufacturing PMI bounced, but still negative. And given that reverberating factor and the exports number that we showed you for South Korea, we showed for Taiwan, Japan is going to keep that negative. Now, when you look at South Korean CPI, even with rates moving up, expectations for 4.5%, came in at 4.8%. And then when you look at, again, South Korean exports contracted for a second straight month in November, and imports were no better. And remember, imports are an indicator of where are exports going to be and where is local demand. We already know local demand is weak and weakening. We know exports are weak and weakening, and that again is going to just drive things lower. So here, when we look at consumer prices, Japanese inflation, excluding the impact of consumption tax hikes, inflation is at a 3-decade high in Japan. And I just wanted to show this chart one more time to tie it all together, where that is insane when you think about where inflation is and where the pressure is going to be, not only in South Korea, not only in China or ASEAN nations as they weaken, but more importantly in Japan, or the fourth largest economy. Japanese industrial production moving down. South Korean industrial production was expected to be at negative 1%, came in at negative 3.5%. Again, all of that showing about local demand as well as export demand. Their industrial production isn't there. And that speaks to global trade, that speaks to global flows, that speaks to their imports of raw materials, semi-finished products, because there's a lot of back and forth trade between these guys and China. And you're just not seeing it, which leads back to the weakening Chinese economy, global economy, how we're not going to see a huge surge and benefit. India's services businesses got slightly better. Was a nice bump up, even though manufacturing got a little bit worse. This got better, which was helped to offset that. When you look at 8 core industries output, It's weakened a bit, but when you look at seasonally, the comps got easier. So comps got a little bit easier, and now I'm sorry, comps got a little bit harder because typically you get a bump. Instead, we didn't get that bump in India, and I think that that's going to be the bigger problem, where seasonality is going to go away a bit, and you're going to get some additional weakness as we go into year end. Again, India is doing better, but they're still subject to the weakening global economy. And that's where we see an outsized impact, especially when you look at manufacturing, slightly up, but we see that rolling with the ASEAN nations, because as you kind of move out from that, China, all those new export orders coming down. Then you look at South Korea and Japan coming down. Then you look at ASEAN, a steep move down. Then you look at leading indicators, all negative in contraction. Again, that's going to lead to more of that in India moving negative. So that's what we have for you today. Hopefully it was helpful. I know it was a lot because we had a lot to cover. If you have any questions, you can, again, find us on Twitter, my email, or on the YouTube comment section. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.